Candle charting can be used in all time frames and markets. As seen with this Cineplex example, it is a Canadian stock, unlike most of the other charts we have looked at from the American stock market. But regardless of the exact market and chart being examined, the same general principles can still be utilized. Within this range, there are many bullish and bearish reversal candles. However, not all of them fit the perfect criteria of the diagrams we examined earlier, and that goes to show it is more important to focus on general price action, such as lower and upper wick rejection, rather than trying to have every single candle in real live markets conform to the exact proportions seen in theoretical diagrams. Here is another example of a strong upper resistance range being surpassed by a strong and consistent row of green candles and increasing green volume. Eventually, the uptrend begins to weaken with more indecisive price action as more dojis emerge, along with some more shift to bearish sentiment with the most recent green bearish star that also has high volume. As you may have noticed, resistance and support levels of major significance often occur around round numbers such as this 55 to 54.5 area, which can offer some resistance, especially as there is upper wick rejection through this range. And there is also the possibility of overextension to the upside if this steep trajectory continues without a major pullback in the near future. A downtrend is more likely now, given that the most recent candle is closing lower. A clear downswing now as the next day continues lower, still with relatively low volume, but it is consistently red. A downtrend does indeed develop, and it does highlight the importance of fast confirmation of a reversal candle. In this case, the market immediately trades below and eventually closes below the low of the bearish star at the peak here. The drop does slow down due to the supporting influence of the 52 range, along with decreasing volume at times, combined with the emergence of some indecision in the form of dojis and spinning tops around this time period. There is also heavy contention pushing the market up and down due to periodic spikes down and up, with some heavy increases in volume for a short time. Two major gap downs easily take price down further, and Cineplex eventually reaches the low 40s, where there is major lower wick rejection in early August. This is certainly no bull hammer or dragonfly doji, but it is one single candle that shows strong bullish context. First of all, it is green with high green volume, and there is, as mentioned, lower wick rejection, with the real body concentrated towards the upper half to upper third of the candle. However, the price action of the next few weeks does not favor the initial bounce off the strong 42 level, with the next candle not even trading above the high of this large candle. Volume is also not exceedingly high, but instead it is consistently red, and this is enough to put further pressure back onto the 42 level. This turns out to be an excellent demonstration of why it is important for immediate confirmation of the market to at least trade above the high of a bullish candle and bullish price action. The exact opposite occurred here, with the market countering this single bullish candle to instead put more pressure on 42, which did support for some time. It even had this bull hammer. However, the downtrend resumed with strength after breaching 42, with a consistent and strong row of red candles and increasing volume. This doji hints at a possible pause or slowing down of the downtrend that could become overextended if it continues with this steep trajectory, and the current bull hammer increases that sentiment even more. It is not strong confirmation, but at least the next candle trades above the high of the bull hammer, and red bearish volume has decreased significantly, while the bull hammer has decently above normal green volume. Certainly it's not a confirmed upswing for sure, just yet. 35 holds firmly, first with this small inverted bull hammer that also has a minor lower wick hold above 35 to eventually see strong closes above the high of the original bull hammer to begin an early uptrend. Notice this bearish star forming to halt the early uptrend around the 38 level, which lines up with the doji seen earlier in this very small continuation that has the general price action of a falling 3 methods pattern, except with only one candle in the resting phase. This is similar to situations seen earlier, where the upper and lower boundaries of continuation patterns with 3 methods rising or 3 methods falling price action serves to halt the temporary development of an early uptrend or downtrend. In this case, the early uptrend is finding significant resistance at the upper boundary of the small 3 methods falling. Amazingly, the market is held down with large red spikes from time to time. However, even these surges do not take the market directly back down onto 35, indicating that the market is still oversold in the long term and unwilling to quickly return back to the mid-30s or even lower. Though eventually the upper 30s resistance persists, and this creates two very distinct bearish stars that are the final downswing to eventually return back directly onto 35 with the help of acceleration from increased red volume to begin 2018. This consistent bearish effort paid off to the downside as the market continued to sell off in the very steep downtrend, well below the strong 35 to 34.5 support range, which continued to have major influence as a major resistance when the market briefly recovered.